Hello, I'm Weston LaBar from Cargomatic, and we're here today with another episode of People on the Move, the Cargomatic podcast. I'm here with Andrew Clarke, an industry expert, a friend and advisor to Cargomatic. He's held positions such as CFO of CH Robinson and Forward Air, and he sits on many of the industry boards and serves as an advisor. Andrew, thanks for joining us today. Super happy to have you. And maybe as we get kicked off, share some of the interesting organizations that you're involved with today.
Well, thank you, Weston. It's always good to be with you, and I appreciate the opportunity to be on the podcast. As you mentioned, been a friend of Cargomatic and the work that you all are doing there. So happy to support the podcast. I started many years ago. I used to be one of the younger people in the room, and now I found myself with maybe not necessarily the gray hair, but the gray beard. And I've had the good fortune of working with a lot of great companies, as you mentioned, CH Robinson, Forward Air, Panther Expedite, in a full-time capacity. And now I find myself doing board and CEO advisory work. I work with a company called GCL, which is probably one of the largest specialty logistics businesses. We do high-end art, we do high-end cars. We do the logistics for a lot of sporting events, including Formula One, 75% of the live performance touring market globally. Taylor Swift, you all recognize that. I work with Ports America. I work with Arrive Logistics, so on the brokerage side. And I also work with one of the largest fleet management companies in North America, Element Fleet. Formerly, I was DCLI, some of our good friends there on the chassis leasing business. Way back was with Pacer Stack Train. So I've been all around in the air, the ocean, the ground, truck, rail, cross border. So it's been a fun and interesting space, as you know, that for many years people didn't pay attention to, and then the pandemic hit and the ensuing supply chain disruption kind of put what we do in the forefront of many people's lives. So it's good to be here and have a conversation on it.
Yeah, no, and I'm super excited to have you today because, as you've just pointed out to our viewers and listeners, you have such a wide variety of experience in this industry. And there's so many people that, maybe they have a deep knowledge of drayage or a deep knowledge of equipment management or a deep knowledge of LTL, but very rarely do you have folks that have actually been in leadership positions in organizations that cover really the gamut of what our industry sees. And one of the things we really wanted to highlight right now is we all know how we've gotten here, right? Pandemic, over ordering, too much inventory, consumers switch back to a service-based economy. We all know those things, but I think what everybody's kind of looking at is what's going to happen in the future. And, I hate the term, when's the new normal going to come? Because if I've learned one thing in this industry, there is no such thing as normal. It's always changing. It's an ecosystem that lives and breathes, and you're just part of that organism. But from your perspective, we've had a lot of people on recently talking about, and I share this opinion, as I shared with you, that, inventory will draw down. Certain inventory will get quote unquote exhausted or right sized, but some inventory won't. And going into next year, a lot of that summer stuff, there's the hope it'll be exhausted. But you have a different take on some of where the industry's going. And I think that's so special because having different perspectives from experts like yourself really help give people the information to frame their own opinions and look at their own information for their businesses. So talk a little bit about what you're seeing with your various roles in the industry, and talk a little bit about where you see it going. And I want to start with that because with you, I'm going to do something a little bit different down the road and talk about the capital markets as well.
I guess, over the last 25 years, people try to suss out what trend lines mean. And for the most part, if you take out kind of the blips, either to the downside or the upside, if you take out the GFC, the Great Financial Crisis, of 08 to 09, and then the recovery back 10, 11, 12. Obviously, we all know what the charts look like from 21 and 22. But if you do take that longer term approach, you see that the trend lines do kind of revert back to the mean. I think what's fascinating is how people react and act during periods of great flux and the like. And so what really you saw that happen where consumers were inside, they had flush capital because not only was the government providing it, this is during the pandemic, but not only was the government providing access to that, they couldn't spend money on things that we would normally go and spend money on, outside activities, dining, concerts, events. And so to your point, you saw those inventories really kind of flex up, supply chains get incredibly stretched, capacity come into the market. And now here we are on the backside of that. And now everybody's trying to figure out what is that going to look like in 24 and beyond. And I would say it kind of feels like it's the 2011 to 2013 timeframe where there is more stability. Capacity is still working its way into, as you know, on the ocean side, on the truck side, not as much on the plane side, but capacity is still working its way into the market while demand has subsided. What does that tell you? It tells you pricing is going to go down. And as we've talked about in the past, you and I, it was Jerome Powell said interest rates are going to be higher for longer. I kind of think freight rates are going to be lower for longer because there really isn't that, there's nothing outside of the normal, be it a supply chain disruption, be it a demand spike that I think is going to lead prices higher throughout all of 24. So what does that tell you? If you're an asset owner, you better learn how to manage and utilize your assets in the most effective manner. And if you're a non-asset based provider, you better figure out how to really optimize your cost structure so that you're able to make it through what I think is just going to be a stable environment, at least until mid-25.
Yeah. And, I have the same opinion. I feel like post Lunar New Year next year, you'll really get an idea of what types of commodities are going to start moving again. And that'll really dictate what volumes look like, I think, for the 2024, really Q3, Q4. And I think you'll see a little bit of an uptick, but it's not going to be a peak. It's going to be an uptick and a stable volume because you're going to get back into normalcy for certain types of commodities. And then I think it's a platform, barring any sort of economic collapse, it's a platform or as my friend Bill Mongaluzzo likes to say, the black swan event for 2025 to become another, growth year, right? And again, there's a lot of what ifs, but I want to throw a scenario at you because the one area that I think could see an uptick in rates because of volume versus capacity is Southern California's drayage market. And the reason I bring that up is because you're right. The ocean shipping industry are building ships at a time where they don't have enough cargo to fill the ones they currently have. That's a race to the bottom, right? It's a race to the bottom. The rail network always does a good job of preserving capacity, right? They're the one constant in this entire equation, but there's a couple of dynamics, and these are what ifs, but I want your opinion. So the ILA and the USMX are in a contract dispute. And we have all seen what happens when shippers see the potential for disruption because of a labor negotiation. They move their cargo to a safe haven. Ironically, this time it's from the Gulf and the East Coast back to the West Coast. You also have at play a couple of things you're talking about that naturally drive volume back to the West Coast. For the folks that haven't relocated all their manufacturing someplace that creates a more conducive East Coast route, the shipping rates are much more competitive in the Trans-Pacific from Asia to the US, with the LA Long Beach rates typically being the most competitive. And then you also have the Panama Canal issue, which is some folks, their strategy was we'll go through the canal. Well, now they can't do that. So they're looking at US West Coast, Canada, or Mexico, because the Suez Canal is really not an option once you get to a certain part of Asia, as you know. And all while that's happening, the state of California is saying, we're going to start retiring trucks and forcing people to replace them with zero emissions, which has had people leave the market, which the last time there was a clean trucks program, 50% of the trucks did not re-enter the market over the next several years. And it was in a down market. People didn't see the value of doing it. So from my perspective, it's a long-winded way to say there's a perfect storm opportunity where the most desirable gateway for international cargo will become, again, Southern California because of all of the different aspects we've talked about at a time when you may actually see contraction in that industry in LA and Long Beach, meaning you could see an uptick in volume, a decrease in capacity. And what does that mean? You could have a microcosm of rate increases in Southern California and on the US West Coast. And I just wanted to get your opinion on that because I think it's very interesting on the international side before we pivot to more of the US domestic supply chain.
Yeah. Well, a lot to unpack there, and I'll start by saying we all know the importance of Southern California, and always on the margin, it'll be up 2%, down 2%, given everything that you just referenced. I mean, clearly during the pandemic, the East Coast ports did see quite a bit of an uptick for the reasons you discussed, and it went away from California. Now you see, because of the issue with the California environmental regulations, what's going to happen in that market. I do believe what you said is exactly right. And I do believe, just again, given the dynamics and the demographics of the United States, California, Arizona, the West Coast, the Southwest is going to continue to be a popular location. And now, given where relative truck rates are and relative intermodal rates are, putting a container or putting the equivalent of a container into a truck and moving it from LA to Dallas is pretty inexpensive today.
Mm-hmm.
During the pandemic, it obviously wasn't. So you could do the ocean rates to the East Coast and have a much better outcome. So I agree with what you said. One other thing, though, that I'm spending a lot more of my time on today is that and that nearshoring aspect. Mexico and the ability for organizations to develop. I just spent 10 days down in Mexico between Torreon and Mexico City, looking at logistics operations down there, as well as kind of that end market consumer. They've got some really good demographic trends that are very long-term and very positive, not only for the Mexican economy itself, but for the Mexican to cross-border U.S. economy that I think is going to play out over the next decade. And so it does kind of argue for more of a West Coast focus, as well as what's happening in the nearshoring. To your point, the Panama Canal is going to be a problem for some time, and whatever's happening between the Suez, that's already happened, right? That I don't think there's any change in the patterns where you're going to see an unnatural spike from where we are today.
Yeah, I couldn't agree more. And I'm so glad you brought up Mexico, because I agree. I think that especially the Trump tariffs that we experienced in 2018 going into 2019 was really when they went into effect. It made people rethink their supply chain, right? We all know some move more towards Southeast Asia and countries like Thailand and Cambodia, et cetera. Other ones have looked even at where they can at the US, and you've seen some of the southern states, the lower cost, but low skill labor states where they can do pick and pack and some minor assembly in places like Alabama and Mississippi, Texas, West Virginia. They've all seen different types of companies relocate jobs, but Mexico has a lot going for it if they can get out of their own way from a governmental perspective, and I think overcome some of the stereotypes that people think about when they think about doing business in Mexico. So talk a little bit about the importance of the West Coast, because I agree with you. And the biggest reason I agree with you is most manufacturers are really logistics companies and final assemblance companies. And I love to use Apple as the example. We all have one of these days, a smartphone, right? And in that smartphone, there's thousands of components. Apple designs it. Apple procures all those parts, but they don't make any of the parts anymore. And then they bring it to an assemblance hub and they put it together. That means one of the biggest parts of their business is logistics, because if they're missing one component, they can't manufacture. And so as you're looking at Mexico, we're very familiar with the auto industry, for instance. Building, Ford for a while had a plant where they were going to really double down on building in Mexico, but those parts were coming from all over. So talk about that complexity, because I think that's the component that really has the ability to enliven and continue to grow the West Coast ports, because my thought process is those components are still going to come from low wage, higher skill countries that maybe aren't as economically evolved as the US and really Mexico.
Well, you bring up a good point, and I would tell you that I don't think many people know this, but Mexico graduates on a per capita basis more engineers than the United States, more engineers than Canada. And so it is a highly educated workforce. The cost of labor there, so if you take Mexico City itself out, which is usually in Mexico probably 3 times as expensive as the rest of Mexico. So you get into more of the northern, the Monterrey, the Torreon, those areas. the cost of labor in there is a third of what it is in, sorry, two-thirds of what it is in Mexico City, which is still less expensive than the United States. So the cost of land there is a lot less expensive. And then when you factor in the cost of transportation on a fully landed basis, it is becoming much more economically incentivized for people to relocate back to Mexico to not only serve, by the way, which is a growing Mexican market itself, a market inside of the United States. So I find that to be both a very positive, bullish trend that's going to unfold over the next 10 years. One final point, and you mentioned, I think it's more perception than what we would consider to be reality today. The country risk premium, meaning the bonds that are sold in the United States versus the bonds that are sold on behalf of the Mexican government, that spread used to be many, many, many points. Today, it's only 200 basis points. So country debt in Mexico is only 200 basis points wider than country debt in the United States of America. So it's not really that much more expensive. If you talk about the capital markets, it's not much more expensive to do business in Mexico than it is in the United States, with the one exception of, as we all know, security. Security is a big issue, but just like anything else, it gets baked into the cost of doing business. If you're going to do business there, you're going to provide more security. Therefore, it's just baked into the cost of doing it.
Absolutely. And I want to take this conversation to the next level, which is, as we look again at forecasting really next year and beyond, you have the ability to see from different perspectives, whether it's the first and last mile side of it with the Ports America, with marine terminals, ocean shipping, whether it's the long haul truckload, domestic freight business with Arrive, and now even as you've talked about the cross border and that nearshoring and how that kind of disrupts. Which areas do you think we will see with maybe that first rebound and then that trickle down effect? Who do you think we'll see the first leading indicators that the freight industry is really on a true uptick and not just a seasonal inventory replenishment?
When I was in my public company CFO days, and anybody ever asked me to give me a projection, I would say, the crystal ball has been dropped, broken. It's a little cloudy. It's all that. So I would not consider myself to be a good prognosticator of what's going to happen. That being said, you'll first see it. And by the way, there are different parts of the economy, which I think, as you know, are doing really well. GCL, Rocket, the groups that do RN markets in that company are Live Performance Touring, really good. Taylor Swift, thank you.
Sport. I love those Swifties, right?
We love them, every last one of them. And she's on her global tour right now, and it's going really well. Sport, Formula One, thank you, Netflix, Drive to Survive. The number of people that have been in Austin, Miami, and now Las Vegas. That's just a great entity that we're happy to be a part of. So people are actually still spending money. They're out there doing it, and so we feel really good about that part of the economy. But to answer your question, you'll first see it, when people start to buy stuff. It's going to show up on ships. I would only look at those container volumes on a year-over-year basis from where they were in 19. That's where everybody's like, the comp is 22. Or the comp is 21. It's a bad comp. It's not a real comp. It's a bad comp. You just got to look at the trend line from 19 to 23. You have to look all the way through it and just average down what we saw in 21 and 22. And so volumes, I think that's where you'll see it first is on the ocean side. But then you really have to look at what is the commodity that they're bringing. Where are the consumers spending their money? And it's going to take a while for that to come back up. Like you and I've talked about, I think it's a 25 timeframe on that.
Yeah, I think that's a great observation. And as we look at the freight market, and obviously, if people don't realize, the supply chain is the lead indicator in what's going on in the economy. And the first thing you look at are purchase orders overseas. And then you look at, are they taking delivery? To your point, are ships bringing stuff into the country? That means that retailers and other shippers really do believe that they have a consumer base that is hungry. So usually it's a 6-month leading indicator. When you see port volumes go up, it's a rising tide for the economy. I think that's been what's so interesting about this cycle, because really we just got a head start on it. It kind of threw things in disarray from a crystal ball perspective. But this year we'll close out the year with roughly 2+%, maybe even get it closer to 3% of a GDP growth, which is normal GDP growth. That's what you want. We had an overheated economy for a lot of reasons. And as part of that, our capital markets have been disrupted as well. And to your point, what we're seeing right now are winners and losers. We're seeing folks that were winning a couple years ago and really won. And if they didn't have the rainy day fund and have good forecasting and planning, they're struggling today because they don't have the wherewithal to weather the storm. We have other folks that were able to weather the storm and get through the pandemic, who are now seeing the fruits of that effort come to fruition. You know, your background as CFO of multi-billion-dollar companies, you have a great insight in the capital markets. And the couple of things that I've seen in this industry, obviously, is you've had some bankruptcies, very public bankruptcies. You have a lot of companies that maybe a couple of years ago, if they were in a tough position because of the cost of capital, would have been able to find some sort of bridge capital. You think of the Convoys, you think of the Next Truckings, you think of some of those that just they're either out of business or headed that way or on the block for a fire sale. You also have the companies in the traditional markets like the Yellows and other that, again, unique circumstances, but at the same time, probably a couple of years ago would have been able to better financially weather some of that mismanagement than today. And where do you see the financial markets going? Because to me, it plays two big roles in this industry. You've got the traditional folks that are looking for growth capital from private equity. You have really the scale up economy now that were the startups 10 years ago that folks like Cargomatic flourishing, other folks out of business. And this has all happened in the last couple of years. But then you also have the innovation sector. You have problems that need to be solved, but you don't have venture capital as willing to jump in the market. All at the same time, we may see a record number of IPOs in the first quarter of next year. So what's happening?
A lot to unpack there. And I would say that I'm a practitioner of companies that are in the public markets. I wouldn't hold myself out to be, because if I was, I would be a trader. If I was really good at predicting where the market was going to be, I'd be trading it, which I don't. My experience is that over time, these things balance out. My career started around the time of Y2K. So I've had the good fortune of seeing the effects of when costs of capital are low, you're incentivized to both raise and deploy significant amounts of capital. When those costs of capital return to normal or higher levels, guess what? The returns that you're required to produce, in fact, go up. Public markets, and now I'm talking about industrial, not what they call them, the Magnificent Seven. It used to be FANG, but now some Magnificent Seven, apparently. Taking those aside, most industrial companies trade on a return on investment. So if an investor gives you $1, they're going to want that dollar back with a return.
Yeah.
And so plus, they're going to want a return on that invested capital. It's very, very critical. And so investors value by a factor of almost 2 to 1, you getting that return, not based on price, but based on, cost, being a more effective operator. You mentioned some of the companies. If you look at the networks that are out there, the rails, the well-run LTLs, and I'll stay away from names, let other people, do that. But if you look at the rails and you look at the well-run LTLs, you'll see that investors value operating margin, operating ratio. Like, they are obsessive around that. There are companies that have had for a decade almost little to no revenue growth, but their market capitalizations have quintupled because they've been able to do a very good job of removing costs, and you think about, the supply chain. What is everybody trying to do? They're trying to remove friction points in that supply chain. They're really trying to not just costs, they're removing touches, they're removing miles. And it's, by the way, there's a huge green element to it as well, of being more effective in the utilization of your supply chain. You could do a better job of managing your supply chain, or I would not advise this, but a lot of companies will just put up another 500,000 square foot distribution center That's not really green. You can put solar panels on it, but it's not really green. If you do a better job of managing your supply chain, you're going to be more rewarded in the financial markets. And that's what you're seeing. Everybody got, bid up during 2021, 2022. And then, the old saying goes, when the tide goes out, we all find who's swimming without trunks on. And, now 23 has been a reset. But there are companies that are still highly valued in the public market and even in the private market. The M&A market went away in early 23 because everybody was trying to figure out how much of these earnings were actually COVID or pandemic related. What is my underwriting thesis, and what am I actually underwriting the EBITDA amount for that through a cycle? Because I can't go to the debt markets because those kind of seized up earlier in the year. And where I was borrowing at 4% 2 years ago, I'm now borrowing at 10% today.
Mm-hmm.
We're seeing this throughout the economy, right? The housing, with the mortgage rates. You're seeing the exact same thing in the industrial space.
Great time to be a cash buyer in any industry, right?
It's a great time to be a cash buyer, and there are still deals getting done today. And I think, by the way, today is a great time because you kind of, for the very first time in the last 3 years, 2023 is a good indication. If you look at 19 and you look at 23, you kind of have a really good indication of if you were able to grow during that time period from 19 to 23, you kind of have a good idea of what the through cycle earnings potential and earnings power of a business is. 21, 22 was not a good view, and a lot of deals got done in 21 and 22. We'll see how they look when the debt ultimately has to reset. But they're really, if you think about those capital markets, there's a lot of capital and cash available to invest in high quality companies. I agree. I think there is a backlog of businesses that need to be sold or need to be taken public. I would really I think quality is going to matter, right? It's not just, hey, by the way, Fed fund rates are at 0, so the door is wide open to the public market. Fed fund rates, again, Mr. Powell is going to say higher for longer, which is probably the right thing. That door is not going to be open for anybody that just wants to go public. It's going to be very, very selective 2024 on which businesses get funded and which ones don't.
Yeah, I think that's spot on. I think everybody's trying to figure out exactly how to make their case, right, to be one of those select few that get that opportunity. And I love what you just pointed out. And I want to re-echo this for our listeners, because I think this is super important. There's two things that show whether a company has actually grown. What did you look like in 2019? What do you look like today? And if you're in our industry, for instance, has your volume grown? Has your revenue grown? Not from last year or the year before, but from 2019. And the second thing, and this is really on the tech forward and the tech valuation side, how many people did you have to hire during 2021 and 2022 to meet your customer demand? And how many people did you have to lay off in 2023 because you didn't have that customer demand or those increased rates and increased margin? And understanding your labor force, I think it shows two things. One is, do you need to hire a lot of people to scale with growth? That means you're not really a technology company, in my opinion. If you have to have 5 people for every unit of metric that you're selling, then you're probably not a scalable technology company. If you've grown, from an employee standpoint at a fraction of what you have from a revenue standpoint, that shows that you're a technology company that has the ability to scale and, to your point, be more efficient and get waste out of the system. And then it also shows, if you had to lay people off, it shows that you needed hamsters in the wheels to make the technology look good on the front end for the customer. And so I love the fact that you pointed that out, because you're right. When we close out the books on 2023, we'll really know who the winners and losers were during the pandemic hot period. And we can tell some of them, right? Like Maersk made $100 billion of profit over a 3-year period. I would say they're a winner, specifically if you look at, and all the ocean carriers, if you look at the trends of what their profits were. But I think it's going to be this land side, right? Transportation. It's going to be the domestic freight. It's going to be the drayage. It's going to be the intermodal, and looking at all those vendors and service providers in a very, very competitive, fragmented industry to say who won, who lost, who's real, who's not. And one quick fact that I'll share with you, because I find it fascinating. We all know that 91% of the fleets are 6 trucks or less. I continue to harp on that because it just shows how big the industry is and how many players there are. But over November 1, there were 57 straight weeks of more motor carrier licenses being deactivated than activated with the FMCSA. And that equated for over 150,000 licenses. Now, many of those could be the 1 truck, 2 truck guys that went out on their own to take advantage of the spot market. But a lot of it is still it's the yellows, it's the convoys, there's larger carriers. Some of them have been family-owned carriers for 50 plus years here in California. They had to close up. They couldn't make it work. And so what you're also seeing in the market is a complete reset. To your point, the winners and losers you don't have to pick them. They're going to pick themselves.
Yep. Yeah, you hit on one of the points that I've been asked, for the last 15 years, and it accelerated in 21 and 22, and even started a little bit before then, is technology. And there are a lot of colorful comments that are out there, some of which were attributed to me in terms of the technology. Every company uses technology. And I think the misnomer that is out there, I would say both on maybe the customer side, but on the investor side, is that transportation companies, pick anyone that you want, doesn't use technology. My former employer, CH, was often thought of as antiquated. They're not. They have great brokers in there. And by the way, I've always been a huge fan of the brokerage industry. I think it's a great industry. There's a lot of value add that it brings, regardless of what other people. I will always stand as a supporter and defender of the brokerage space, and whether how effective you are in terms of your people, hiring the best and the brightest and the most dedicated people, I think is the first thing. Do those people know how to move freight? Do they have a process that they can repeat day in, day out? And do they use technology to make the customer or carrier experience better? Those are the 3, I would say, buckets, and the way that I look at them. And again, I'll go back to, when the cost of capital is essentially free, a lot of ideas get funded, and a lot of, quote, disruptive ideas come to the fore. And now when the cost of capital has risen and the money runs out, how do you make money? You make money by buying and selling freight. That's how you make money. And I think that's something that a lot of people lose sight of during periods of these incredibly bull runs on the capital side. Is you don't make money in terms of selling technology. There's not a transportation company that I'm aware of that has transformed itself from being a transportation company into a technology seller. Now, they'll use technology, and that's great. But I have yet to find and I'd be happy to have the discussion with somebody who's done it, because I'd love to learn from it first and foremost. I'm not saying it's not going to happen. I'm just saying I haven't seen evidence of it having occurred. But I'd love for somebody to say, hey, here's how we've transformed from buying and selling the movement of freight to the buying and selling of technology that allows you to do it more effectively. And at the end of the day, that's how we make money, is buying and selling and moving freight.
Yeah, I think this industry, and then I want to get to closing thoughts, but I think this industry, and whether they're trucking companies, marine terminals, ocean carriers, whomever, I think over the last several years, many of them went from discounting maybe the importance of the technology and the data. I have a system. I spent millions of dollars on it 10 years ago. Well, that sunken cost fallacy actually is a hindrance to be able to grow the business in the modern freight economy, right? And so one of the things that I would impart, to summarize what you're saying, is technology and data, the value is what you use it for and how you create money leveraging the technology and the data. The technology and the data inherently has no value in and of itself. It's how you leverage it. And I think, I could have oil, 50 years ago, I had oil under my property. But if I don't have somebody that can turn it into gasoline, there's no value to that oil. It's just carbon sitting under my land. And I'd say that's the modern technology and data. It's how data has value when you use it properly. You need to use technology to leverage the data. That technology can help you improve your margins, increase your revenue, or have a better product so you have more customers. And I think people lose sight of that. I just want to switch it over to you for any final thoughts, observations, because this has been fantastic. And like I said, it's been very different than a lot of our other series that we've had with other guests on the podcast. And thank you for joining us. So any last big words of wisdom or things people should look for? The floor is yours.
Thank you. I do appreciate it. I'll hit on what you just talked about with data and information, and the separation of signal from the noise. There's a lot of data out there, and to use your analogy, you can even get it out of the ground. What do you do with it once it's there? What decisions are being made? Thankfully, we didn't hit on AI, machine learning. That would be well outside of my swim lane in terms of knowledge, expertise, or focus. But I do think that the smartest companies and the best providers are the ones that know how to both harness and capture and make better decisions for data. Ones that, as I mentioned, make their customer experience better, in transportation, make their customer experience better, make their carrier experience better, and make their own stakeholders, their own employees better in that regard. There are a lot of great jobs, there are a lot of great opportunities that still exist in this space because we're going to continue to see logistics grow at a GDP plus rate, right? It's going to continue to be complex. It's going to continue to require highly intelligent, highly skilled people to do it. And if you're affiliated and working with an organization that's figured out kind of how to do that, there's always capital to go out and raise. There's always the ability to go raise capital, build a very, very successful business. And once you do that, then the opportunities are open. You can monetize that in many, many different ways. You can monetize that through the public market. You can monetize that through the private market. There's great opportunities. And I would say that we found out, to your point around the bankruptcies and the like, we found out who was a good operator in 23. We're going to continue to test that throughout 24. I think it's going to be a lower for longer, and I think this is a great opportunity for well-run, well-financed organizations to take advantage of.
Great words of wisdom to close on. I couldn't agree with you more. And I really want to thank you for joining us. You gave us a little peek into how busy you are and all the different things you're engaged in. So we really appreciate your time. I want to say thank you to our listeners for joining us and our viewers for joining us today. Again, Andrew Clarke, one of the real bright minds and great leaders in this industry. And we're just so fortunate to have a relationship with you and to call you a friend. I'm Weston LaBar for Cargomatic. This is another episode of People on the Move. Thanks for joining us.